In wealth management, better decisions don't start with analytics, they start with data you trust. Hello and welcome everyone. My name is Hagander from WealthArc, and today with me is Stratos Mavrogiannis from BlackRock, Aladdin WealthTech. Together in this series, From Data to Decisions, we're exploring how structured analytics and reliable data change the way advisors report, explain, and act, especially in complex markets. Because when the foundation is right, everything built on top becomes more confident. Welcome to episode 2, where we will discuss how you go from reporting portfolios to really understanding them. I want to share an interesting observation. Reports have continuously improved over the last decades. They've become cleaner, conciser, and more visual. Still, I hear a lot of wealth managers complain that they still don't really know what drives their performance.
I totally agree with you. I think reporting and understanding are fundamentally different things. Reporting is more descriptive, understanding is more interpretive. And you can have reports that can be very good at describing stuff, but not interpreting them. So what we see a lot these days is reports that have observations of data points, but not real connection between these data points.
So what are the typical pitfalls if you just go on and report data points?
So let's think, what happens if you analyze different parts of a portfolio in isolation and not combined together? Let's start with performance. You can have the best performance, start delivering, but then you might be highly exposed to single market events that you don't know. The other thing is exposures, allocations. You can have a very well diversified portfolio, but then again, you might be very highly exposed to a single market event that you haven't tested your portfolio with. And that comes back to risk. So you can use risk to understand the other two, but what happens if you look risk in isolation? You can become too pessimistic, try to manage that risk, and essentially miss out on opportunities. So what I would like to say is that all of this comes down to relationships between exposures and allocations, performance and risk, and that's how we should look at portfolio analysis.
So essentially you're talking about a holistic and contextual view on things. And tell us, Stratos, so how does that level of insight change the way products are being selected and investment strategies are being defined?
I would say it helps establish a forward-looking view of risk and value drive, essentially trying to understand what happens in your portfolio or what could happen in your portfolio in the future. And the impact of this is that it helps establish confidence in the analysis that a wealth manager performs for their portfolio and ultimately how they communicate this to their clients.
So essentially it will lead to an asset allocation that is not just cosmetically beautiful on the surface, but actually in consideration of its sensitivity to macro factors. Could you name any tools that would be helpful to unpack this?
As an example, we have Portfolio 360 and we have placed that on the WealthArc interface. And the reason for this is that we want to help wealth managers essentially with a click of a button transfer clean allocations into a portfolio analysis tool that can help them unpack the relationships between risk, performance, allocations, or even stress testing. And that's the idea. Try to provide a view on the interconnections of all of these aspects in order to lead to true understanding of portfolio and not just data points. And this is exactly why essentially connected analytics matter, because that's when advisors start seeing the connections behind the outcomes and not just the outcomes.
So we know that wealth and portfolio managers are responsible of selecting products, defining the strategy, or benchmarking the performance. In your point of view, what are the key differentiators that will really help them to stand out?
For me, forward-looking view of risk and stress analysis is what can differentiate wealth managers and set them apart from the competition. Because you move from just examining historical observations into testing the resilience of a portfolio into the future.
So it's sort of an exploration, yes?
Exactly. For example, when you're testing your portfolio for specific scenarios, what if the stock market goes down by 10% or inflation rises? What is the real impact? How do we test the resilience of our portfolio? And that's, for example, where Portfolio 360 comes in.
Very interesting indeed. So, in your opinion, what can be achieved ultimately if these insights are being used properly?
First of all, reduce noise.
And there is a lot of noise.
There is a lot of noise. And you need to understand what fluctuation in the market really matters and what is just a fluctuation, what is just some noise. The other important part is essentially aligning the risk tolerance of your client with the portfolio, because that's key. Another important part is shifting from just validating outputs on reports to truly understanding what these outputs mean in connection with the different aspects of the portfolio that we discussed. As we already said, creating that confidence in the data and observations that you see and not just guessing based on this data.
And at that point, portfolio managers and wealth managers will go from just reporting portfolios to proactively managing them. And that's why we believe portfolio tools have to go beyond reporting to real contextual understanding. So ultimately, better decisions don't come from more data, they come from data that is structured, trusted, and understood. And that's really the journey from data to decisions, and it all starts with foundations you can trust. Thank you so much for joining the conversation.